Good morning, everyone. 7:16 here. I guess more people will jump on as we go, but might as well get started. If anyone has questions throughout, please let me know, and I'd be more than happy to answer those at any time. So let's get rolling here. Today, going to do a quick USDA recap. It's kind of been the major driver between what's happened over the last week in the futures market, spread market. So we'll start with that, do a quick market recap on the commodities, and then we'll let the group go into the local cash discussion here. So, quick recap, we got a major surprise on the 10th. Corn carryout was cut, yield was cut more than anyone really anticipated. It was way outside the range. They did make a few adjustments to the export side and reduce feed and residual as well. On the beans, we also got a major cut, mainly in production, left most of the balance sheet unchanged after that. The Milo balance sheet, they never really seemed to care much about. Left it mostly unchanged. We did see an increase in domestic use and an increase in production that basically offset each other. On the wheat side, minor adjustments between classes. The hard wheat balance sheet did see carryout grow minorly, but nothing really to move the market. The one other part of the report, winter wheat seedings, came kind of in the analyst estimate, up 1%. But the biggest thing was probably the configuration of those acres. Texas, Montana were the two biggest upstates. I think people had Kansas more near unchanged. So I think we still have a lot to figure out as we go through with these winter wheat seedings as to what was actually planted. And then also, the condition of these crops. As we all know, spring weather makes wheat, but we'll have to see what the actual harvested percentage is, and all of this can change as we go throughout the year. So as we go and look at old crop corn, USDA slashed the stocks to use ratio by dropping the production. This puts us in a range to where we are pretty tight. The world is very tight corn here on stocks to use. As you can see, it's one of the lowest major exporter stocks to uses out there. That has led to our flat price rally that we've seen being able to break out of the range. On the U.S. balance sheet side, we have to maintain this current export pace. As you can see, we are sticking right along the export sales progress, but we have to maintain that. And part of that's going to be South American weather. Can the U.S. stay competitive with South America once that crop comes online? The major exporters carry out to use is just another look on the far top right. As you can see, it is one of the lowest. I just wanted everyone to see kind of the configuration by country as to how the carry out to use actually looks. One other piece, ethanol margins. We continue to see a lot about ethanol. Ethanol margins are not good right now. So the question will be is, will we see the industrial use continue to be there at the same pace we have been for the previous start to this year? Or will we see that, slow down a little bit, or will that move over to sorghum, or, will just overall use get reduced? So old crop corn broke out of that trading range that we had kind of been locked in between 430 and 455. Highlighted the day, that was the 10th. That gave us that breakout that let us move higher here. We were higher again this morning here. A major part of that has been the fund position. The funds continue to extend their length. But as you can see, we're starting to near the net managed money long that they've had here over the last 20 years. So will the funds continue to push into this market? And I think if they do, it'll have to be driven by continued exports. We'll have to see that demand, or, and that'll be fed by South American issues. Does Argentina go hot and dry and cause a reduction there? So for now, I think, price target probably $4.90 to $5 here if you have old crop corn left to sell. Otherwise, I think you just kind of stay patient. The downside is probably $4.50. Just the balance sheet is tight for old crop. So I think you have time to be patient here and at least lock something in above $4.90. One thing to look at here is new crop corn. So the corn bean ratio should push acreage to corn. I put my estimated balance sheet on the far right there. If we get good yields, we could be back above a 2 billion bushel carryout again. And that's probably 4 to 425 December new crop corn. We'll have to have good yields and everything to get there, but, we can at least anticipate the acreage getting in. One thing to look at if guys have not priced any new crop corn, I put the front month marketing year average highs. As you can see highlighted in green, typically the high of the year is put in somewhere between April and July. So if guys are looking to lock something in, that is a good time to start marketing 25, 26 corn. I think a good target's probably that 460 to 475 range. And, we'll just have to look and see if we can get that high. But if we get into April and May and no one's locked anything in, I would probably look to market something there. One thing we are seeing is the old crop, new crop spread continues to firm. We saw it somewhere around a 25-cent inverse, trade up to a 35-cent inverse. And there are a lot of people putting in CSOs, which is a way to bet on the spread rallying at 50 and 60 cents. There's been a lot of volume trade at those levels. So people think that old new spread will continue to invert. So even though the front end could trade, $5 corn, that doesn't mean that Dees 25 corn is going to follow it. So we'll have to watch and see how that moves along. Any questions on corn? So let's move into the wheat market. It's probably the most bland market out of the three. We're in dormancy time of the year. Russian exports are still fairly cheap. The funds are short all wheat at this point, getting near, historic shorts when you combine all of the different exchanges together. So, as we sit there today, there's not much to talk about. We do have political risk floating out there. And then in a month or two, we'll get into spring weather that should add some volatility for us. Looking at old crop wheat, we've been locked in this trading range for nearly 3 months now. Really, there's nothing to drive us much higher. The funds have continued to add to their shorts, as you can see on the bottom left. We're not near the historic short for hard wheat by itself, but we're nearing a level where, typically we can see a rebound and then cover in some of their shorts, but normally it takes a fundamental issue to get them to cover that position. So for now, I would still leave a target of $5.75 to $6 on old crop wheat. I don't think it's going to take much to get us to rally. We just need to find something out there to do it. As you can see, the world major exporter carry out to use is near the lower end of the range. So if we start feeding a lot of wheat around the world, or find some export demand out of the U.S. now that we are competitive into kind of our more routine area, we've seen Nigeria pick back up. We've seen, Mexico be in for hard wheat. So there's at least a little hope here as we drift lower in flat price in comparison to corn. The other thing we are seeing is feed wheat working all the way through September at this point. So that's one thing we'll have to watch on the overall balance sheet, is how much feed wheat gets put on the books here while we're trading cheap in comparison to corn. And looking at new crop, typically, the highs of the year are put in that April to June timeframe. So if guys are looking for a spot to lock in some new crop corn or new crop wheat, it's before harvest. So get in front of your guys. If we do see a rally, probably take advantage of it here. I think a good target's above $6 at this point. And, as we look at the hard wheat balance sheet going out into 25, 26, we probably land in a very similar range to where we are this year. Anywhere from 370 to 425, I think, is a fair carryout number for hard wheat. And, with that type of carryout, I don't think it's overly bullish new crop wheat futures at this point. It's going to take some issue around the world. I think world crop conditions aren't great at this point. I don't think the Russian crop didn't go into the ground great, didn't go into dormancy great. So we'll have to watch spring weather and really see how these crops come out of dormancy and what production estimates look like. I think initial estimates for Russia are somewhere 80 to 83 million metric tons. So not a stellar crop, but still good enough that they could export somewhere between 35 and 40 million tons. Touching on the wheat feeding part again, the corn wheat spread has pushed demand into wheat. The question will be is, how much wheat can we feed? Historically, you probably feed somewhere between 50 and 80 million at this kind of price ratio. So if we can, stay at this level, maybe that pushes to the upper end of the range. I plugged in 75 for my balance sheet, and I still get a 420, 425 carryout out there. So I might be a little aggressive on production at this point, but it kind of lays out what we could see for the balance of this year. Any questions on wheat? All right, so soybeans.
Hey, Dave.
Yep.
Dave, any of this pickup and exports on wheat translate to any old crop action out of any of our rail assets, terminal assets?
Yeah, I mean, if we could see some more Texas Gulf demand or, more Mexico rail demand, I think it could, give us an opportunity to sell some excess trains if we need to move them. But I still don't know if those values will compete with domestic values. I mean, that's been kind of the major issue is, you look at domestic premiums versus what's trading to Mexico or Texas Gulf, and we're still better off utilizing those assets for domestic purposes. So moving into soybeans, as I said, they cut, overall carry out considerably. One thing that we have seen is continued buying from the Chinese. Part of that is the South American crop typically is running full steam, in February. Right now, it doesn't feel like their harvest pace is catching up with the boat lineup. So we're seeing the tail for the U.S. extend out here, and we see, sales every couple days of beans to China. plus Sino Grain has been buying beans for reserve. So that has led to, a continued export program here that we really didn't anticipate. Um, on the crush margin side, margins remain depressed versus what we've seen in previous years. And as we see, crush is only going to grow here. So as we see all these bean plants come online, will crush margins be able to hang in there, or will crush margins go back to where, it's tough to crush? They got to be better in buying beans. You just can't buy beans and expect a 250 crush number. So that long term will be interesting to watch. Also, the offtake of meal, where is that meal going to flow to? So I think as we progress here over the next 3 or 4 years, that meal piece is going to be very interesting to watch. What markets have to change to take it, and what markets does that displace? South American production, Brazil, that crop still looks like it's increasing. The offset to that is Argentina with La Nina. Could go hot and dry and reduce that overall crop. So very similar to corn, if Argentina could slide for both corn and beans. So it's something to watch as we move forward here. But the big piece here is the overall carryout to use is increasing basically on the Brazil side. So the upside to this market is probably very limited here. As we look at the future side, beans broke out with corn. We had been kind of locked in a very tight 30-cent range for a few months with a couple dips and stuff that traded outside of that range. But overall, we just really didn't have any new information to drive us, and them cutting export or cutting carry out gave us that pop here. So if you do have any old crop beans left to sell, it's probably a good opportunity, as we have rallied here recently. And, as we look at the world balance sheet, US beans, once Brazil comes online, we're a $25+ premium to Brazil. So that should shift to South America, any of the demand. There will be one-off buying if the reserve continues to buy, but I think the export pace definitely drops off here. Looking at new crop beans, somewhere 10 to 1050 has been where we've kind of grinded here. I don't know, at least here short term, a lot's going to depend on the acreage configuration in the spring. If they start anticipating 93, 94 million acres of corn at the expense of soybeans, maybe we get a rally to try to buy some late acreage. But, the bean balance sheet looks comfortable today. So I don't think there's anything, super explosive for new crop soybeans. The last piece on the commodity side is sorghum. Is China going to show up? That's a major question. I think the entire Western market is looking at. If we go back and look at some previous years, there are some similar years where the marketing program really didn't start until February or March, and then picked up from there. As we wait and see what Trump does and how China reacts, that program could come back into pace. USDA is still estimating a very solid export program for sorghum. I don't know if they just haven't touched the balance sheet or if they anticipate them actually coming back here. In the meantime, we have seen a big switch in domestic use. We've seen milo push into different feed rations and into the industrial side. And USDA picked up part of the industrial side, and I think there's probably some more in the balance sheet for that. But overall, it's going to be, are we going to have to feed this, or will China show up and actually buy milo? So hopefully we find something out here over the next couple of weeks. The last piece of this puzzle is Trump 2.0. Started yesterday. We have a lot to get through here. We have major trade balance deficits with China, Mexico, Canada. How does Trump handle those differences in trade balances? Is it going to be tariffs? Are we going to see, some kind of agreement come in to offset that difference? Also, 45Z, the clean fuel tax credit. How does that play out going forward? And, some different geopolitical risks. All the time we could have an issue in Russia or other issues that do drive this market one way or the other. It's, I don't think we've ever been affected by geopolitical risks as much as we have been here over the last 3 or 4 years. So, we'll have to watch as we move into 2025, what this market brings for us. On the far right side was values for corn and beans under Trump during his first presidency. We traded extremely cheap during that time frame. So, we'll just have to see what the second term gives us. So that's what I have for today. If anyone has questions, let me know.